So far on this channel, I've talked a lot about the big six banks in Canada and touched on some of the online banks like EQ Bank. I have not really talked about the smaller to mid-sized banks yet, and that's about to change, and that change begins right now. Canadian Western Bank, who also operates under the name CWB Financial, is a mid-sized bank based out of Edmonton. They were officially created in 1988 with the merger of the Bank of Alberta and the Western and Pacific Bank of Canada. As far as their brick-and-mortar presence, they have branches in the West mostly, but have expanded into Ontario. Their online presence is a different story, as their online bank called Motive Financial is available nationwide. As a bank, they offer the same traditional services just like the big banks, with everything from savings and loans to investment options. They also have services catered to both regular people as well as businesses, though they really like to point out that they provide top-notch business services. As an employer, they also provide a pretty good working environment, which is why they were named number 20 on the 2022 Best Workplaces in Canada. That is absolutely not too shabby. Of course, all of that is just window dressing, and what we want to know is if they are a good investment. It is time to look at their fundamentals. Canadian Western Bank trades on the Toronto Stock Exchange under the ticker of CWB. They have a market cap of $2.77 billion with 91.57 million total shares. At the time of this recording, their share price was coming in at $30.36. This all looks fine until we take a look at their share growth over the last year. Last June, they were selling their shares for $35.55, so we did have a drop of 17.3%. Holy banana bread, that does cause a little bit of concern. However, things may not be as bad as they seem. Before this current market downturn, their share price peaked at $41.50, so they were on the right track before the market decided to tank. Okay, so we will have to address this drop in price, but before we do that, let's look at the rest of their fundamentals. One of the next things I wanted to see was their price to earnings ratio, and it came in at 8.00, which is actually not bad at all. For comparison, Bank of Nova Scotia has a PE ratio of 10.3, and Toronto Dominion Bank is at 12. That does seem to suggest that in terms of valuation, CWB may be at or slightly lower than their fair market value. This is a trait often associated with a good growth stock. Their earnings per share are 3.80, and in digging a little deeper, their diluted earnings per share are 0.82. We have not talked about diluted EPS before. In a nutshell, the diluted EPS is a very conservative metric that indicates the worst case scenario in terms of EPS. It is basically the EPS of a company after all securities are converted to common shares. The larger the difference between the EPS and the diluted EPS, the more there is a chance for share price dilution if their non-common shares were all converted into common shares. In the case of Canadian Western Bank, yes, there is potential for dilution, but I am certain it was not the reason their share price dropped at all. Looking at their diluted EPS for Q2 of last year, it was the same. Dilution is not the droids we were looking for. They also have a dividend with a yield of 4.092%, which is paid out quarterly in the amount of 31 cents per unit. Going all the way back to 2007, their dividend has been consistent and has grown every year. Things overall look good for this bank if you ignore this year. Did I just say ignore this year? Come on, let's face it. As investors, we do not have the luxury to do that. The reality is that their share price did fall about 36%, and that is not insignificant. The big banks fell a little too in this market downturn, but not even close to the amount we see here. TD was down about 12%, while the Bank of Nova Scotia was down about 11%. Even if we are very generous and forgive Canadian Western Bank about 16% of that drop, that still leaves us with an extra 20%. So what is going on with that? Their total revenue was up 5%, which does restore a lot of my confidence. So to get the answer as to why they dropped so much, I went to one of my favorite source materials, their quarterly report. According to them, their loss in share price was due as a result of the impact of higher non-interest expenses and higher credit losses with slightly lower revenue than expected. Their reasoning, well, yes, it does resonate with the fundamentals, which is good. On the bright note, their lower revenue is compared to Q1. If you actually compare it to Q2 of last year, it was up a little, which is actually really good. Q3 is expected to look better as interest rates rise thanks to the Bank of Canada, and this extra interest offsets increased credit costs. Credit costs will be up for a while as businesses and borrowers adapt to a post-illness world, and also adapt to higher interest rates. With their continued growth in physical and virtual banking and the extra revenue from the rate hikes, Canadian Western Bank looks a lot stronger than they initially appeared to be. And that is one of the reasons it is always good to dig deeper when deciding if something is a good buy. In the case of CWB, I do believe they are a solid buy with some growth potential. They are not blue chip, but I do suspect they are recession proof. Full disclosure, I do have a few of their shares in my portfolio, and I am expecting some growth from them. As always, if you like this stock, just remember, I am only the beginning of your research, and a financial advisor, well, they are the end. If you guys loved this video, be excited. There is way more to come. Until then, why not watch one of these videos? And before you jump into that content, just be sure to like and subscribe to support the channel. I'll see you in the next video.